This is Under the Lens, featuring economic research by Gordon T. Long, editor and publisher of GordonTLong.com. The content of this presentation is strictly the opinion of Gordon T. Long and is based on facts he feels to be accurate as a result of his research at this time. All listeners are advised to independently verify all research for market changes. The following opinions are not in any way a solicitation for business, nor should they be considered investment advice. You should always consult a registered investment advisor before making investment decisions. Now, let's join Gordon for today's show.
Good morning. It is Wednesday, October 22nd, 2014. I'm Gord Long at GordonTLong.com. As is normally the case, I have a lot of charts for us to go through this morning, so therefore I will pass over some of them quickly, but leave you to examine them further at your leisure. You'll need to open your viewer to full screen viewing or you'll not be able to see some of the detail I will be discussing. A reminder before we begin, do not trade from any of these slides. They are for educational and discussion purposes only. The purpose of the audio is to discuss key developments in those areas not specifically updated in this month's Global Macro Tipping Points Research Report document. The research report document this month updates global risks. Therefore, the slides this morning will focus on our other three report areas of the GMT report, the macro, regional, and U.S. economic developments. As I often do, I'd like to tie them together into a discussion. Although I discuss it in this month's written GMTP, I want to focus specifically on why event risk has suddenly become important. I am therefore going to show a few more market charts than I normally do in the GMTP versus our MATA report. But I think the integration and overlap will serve us in better appreciating the cross currents at play. I would therefore like to discuss geopolitical event risk, a phase shift, and three questions that need asking. Why confusion possibly reigns. The Fed flows have stopped and what that means and what is going on here. And what will central banks do and when? Shakespeare wrote, "When sorrows come, they come not single spies, but in battalions." Jeremy Warner for the Daily Telegraph in London identifies 10 such sorrows in his 10 biggest threats to the global economy. None are new, but are garnering more media coverage. Some of these we've talked about in previous reports and audios. I discussed this list here in a recent macro analytics tape with John Rubino entitled Phase Shift, and we discussed these 6 potential event risks. And to quote John, headlines suddenly begin to seem both oppressive and really, really numerous, and maybe we're not okay after all. That was his way of summarizing how people's sentiment suddenly shifts and how they start to look at the same thing in different ways. And that is the question on the table. Is that what is happening here? Maybe. This is what happens when a phase shift occurs and the stages that we go through. And the question is, are we in a new phase or is this nothing more than a normal, expected correction consolidation in a continuing uptrend? And we haven't broken the clear uptrend long-term channel yet. The world, according to Deutsche Bank, now faces 10 significant factors that will, one way or another, drive markets for the remainder of 2014. And we can overlay these onto the previous list of event risks. Some are stateside, some are in Europe, some are in Asia, some are around the world. And they think the sky looks pretty clear if you really look at it, but some of these could blow up in our face if we're not very careful. So the question on the table, are these bigger and more serious problems than we were seeing while the market was going up? Or is it actually a matter that we are reacting differently because our mood and sentiment has changed for some reason, and we can debate what that reason might be? Or are we unknowingly over-focusing on these problems now only as a result that the fact is that the market is going down? And maybe the market is going down for other reasons than we're currently discussing, like reduced liquidity flows that no one seems to be talking about, at least yet. The most fundamental problems that we have, that we need to really remember, is that currently we have no effective price discovery available to us because the markets have been so manipulated for so long through what I've referred to, and we've talked about extensively, of monetary malpractice and the items listed here on this chart. We have mispricing of risk that is a consequence of that, and we have malinvestment being hidden because it's being rolled over. Debt continues to be rolled over. When was the last time we had a bankruptcy? Have they been forbidden, or are they just being papered over? There is simply too much middle-class turmoil going on in America not to be seeing more business failures. It makes the point very clear. Excess liquidity is camouflage and hiding huge amounts of issues. And as Warren Buffett so famously said, you don't realize who was swimming naked until the water goes out. Is the Fed manipulating the markets for many reasons, including keeping the perception that things are okay? If the markets are up, it is really tough to get anyone to listen to you about problems. When the market is down, they suddenly listen keenly. There is no doubt about the Fed's many programs which have been directed at economic improvement, but just maybe there was a lot more going on here and still is going on, and they still understand the importance of it in controlling sentiment, perception, and mood. After 6 years, they certainly haven't delivered any sort of stellar recovery despite $4 trillion in balance sheet increases. Everybody is screaming of the damage that quantitative easing has done. But the one thing that has followed these increase in the balance sheet is the incredible R-squared fit of the stock market. I'd like to quote Jim Reed over at Deutsche Bank, and he points out, and this is his chart, quote, "The recovery from the lows after Bullard spoke is another reminder how addicted markets still are to liquidity. Indeed, in our this is Deutsche Bank's 2014 outlook, it showed the various phases of the Fed's balance sheet expansion and pausing over the last 5 to 6 years and its impact on equities and credit. We have found that the relationship broadly works best with markets pricing in the Fed balance sheet move just less than 3 months in advance. So, end of July, early August 2014 was always the time that this relationship suggested markets should enter a new, more difficult phase." Continuing with Jim Reed's commentary, "With this lag, the table shown here rather neatly shows the pulsing reaction of credit and equities to the growth and pauses in growth of the Fed balance sheet around the Lehman demise, QE1, QE2, and QE3. After the initial emergency expansion of the Fed balance sheet in 2008, where risk assets still declined, they would have declined much, much more without it, we have alternated between aggressive balance sheet growth and large to huge risk on one hand and small balance sheet runoff risk off on the other. This period post the end of July is just the latest evidence that this pattern is real. So we still think central banks hold the key to the markets going forward, and there seems to be a hint of change in the Fed. So maybe they're not going to follow through with everything they have been spewing, which, as you know, has long been my position. It isn't just that the stock market has been manipulated, but critically important, both the bond and credit markets also have been and follow the same kinds of patterns. Some would argue the currency and commodity markets are also following the same kinds of patterns. Fed policy actions follow very closely technical indicators that seem to trigger the Fed taking these actions, these Fed policy announcements, which then in turn move the markets. I'd like to talk about a few. Here I show stock quotes that are not filled. They signaled recently, based on past Fed actions, that they were going to do something very, very soon. In fact, I believe they did. They did not disappoint, which I will show in some stock charts in a moment. Here is another. Market uncertainty has never been higher, as this Bloomberg chart of the CBO's VVIX index shows. It is an indicator of the expected volatility of the 30-day forward price of the VIX and reached extreme levels recently. The Fed watches this very closely. it ties into the pricing of options. And as I've written about, they have now established a major contract on all of the options exchange, COBE, COMEX, etc., on a volume discount. And the increase in options with the decrease in volumes, so clearly the Fed is in the options market. While all eyes are firmly focused on the toing and the froing of the VIX, the so-called fear indicator, it is the uncertainty of that fear or greed that is exploding as the VVIX measures. Simply put, the chances of VIX doubling or tripling in the next 30 days, which include the final POMO and Fed end of QE meeting, has never been higher. The Fed, as I said, watches this closely. What else do they watch? Liquidity has become paramount and a major problem in key markets like the repo market, which underpins the shadow banking system. I've talked about this fairly extensively. I've talked about the shortage of bonds as of U.S. Treasuries as the Federal Reserve becomes a dominant player. Why is that important? It's collateral. It's tier 1 capital for banks. It's high leverage capital. Without it, it restricts their ability to lend. They need that collateral, and the Fed has taken it out of the market. Which shrinks their ability to really effectively lend, theoretically. However, when the highly traded E-mini contract loses 40% of its liquidity in the last quarter, the Fed stays up late at night. This becomes a serious issue. These are signals that force the action. These force the Fed to take some action. So suddenly, as the markets are falling, out of nowhere, Fed's Bullard makes a statement that QE may not end and rate increases in March may not happen as expected. At the same time, mysteriously, ECB rumors appear that they are now buying covered bonds. What happens? Markets reverse violently. But it isn't the degree of the reversal. It isn't the degree of forced short coverage and the unexpected statements and the rumors, but rather the exact levels the market was taken to on such small market trading volumes. Like an illegally controlled roulette wheel, which is stopped exactly where it needs to be for the house to win. The market broke technical levels precisely that completely reset computer technical points for those who follow this closely. The market technically would need a catastrophe to now break through the existing recent lows versus forming what is referred to as a consolidation triangle and eventually turn this into a consolidation as the market continues an upward trend. It's called painting the tape, and nobody appears better at it than the Federal Reserve and their affiliates. So what is an investor to do? Corporate debt is back to 2007 peaks. So is stock buybacks. So is investor bullishness. So is margin debt. And investor complacency is at record low. All of these are 2007 peak levels. This is a perfect recipe for a crash. But that doesn't mean it's going to happen. As a sailor, I'm often caught in situations where the waters are rough, the tide and current are in one direction, the waves and swells are in another direction, while the winds are gusting and veering in yet different directions. The question then is, where is safety? And what should be done now? The solution is often found by looking at the skies on the horizon for clues. The bigger picture often gives us the right perspective, though everything around us seems very chaotic, because we can't get a frame of reference. With 75 million baby boomers retiring at the rate of 10,000 per day in the United States, the U.S. Treasury and Federal Reserve face the primary challenge of financing the ever-expanding debt with rising entitlement payouts and shrinking contributions from retirees. Interest rates must be lowered, minimally kept low. The bond market and credit markets must be kept highly liquid. But this is not what is presently happening or being signaled, and may in fact be what is causing all the near-term turbulence and soon prompt longer-term actions. Let's talk about how the Fed flows have stopped or are now stopping. The Fed's taper program comes to an end next month, and the impacts, I believe, are already being felt. As we showed earlier, the 3-month forward Fed balance sheet level has tracked closely to the S&P 500 price change. Flat would suggest a flat market. However, markets work on liquidity and the change in liquidity or flows. Looking at the 13-week rate of change, which matches the quadruple witch cycle and closely approximates the FOMC end-of-quarter meeting cycle, we see that the markets are reacting and following rate of change. ROC has just went negative. Richard Duncan at Macro Watch does some outstanding proprietary work on liquidity flows. He has been hammering the table for some time that the Fed will need to reignite liquidity or the U.S. will face a recession. As you see here, U.S. liquidity went negative in Q3 and will be even worse over the next 2 quarters. Richard also looks at total global central bank liquidity to see if the ECB or the Bank of China liquidity actions will be sufficient to offset U.S. actions. The bottom line here is that it isn't, at least as now perceived or estimated or being signaled. It turns out that not all liquidity is actually created equally, especially when commodities, for example, are primarily priced in U.S. dollars. There is a big problem looming unless the Fed resorts to further balance sheet growth, and very soon it must begin to send signals. I think what the Fed will do is very apparent and quite obvious. Actually, they're trapped. Once the required bond rotation is happening, the Fed will reverse course. They are very cognizant that another QE program will ignite major concerns about the Fed policy. I believe it will trigger an equity lift as stocks rise on the fact that more U.S. dollars are required to buy them. That is, they become more expensive. All of this is unfortunately destroying the underpinnings of the capitalist system. I laid this out in the September edition, The 12 Ways QE is Destroying Capitalism. This is the most critical element, but is one that will go on until a very serious crisis looms. But it doesn't stop the current Fed actions from continuing for some period of time. They have not yet reached the panic stage. I think they're just in the highly concerned stage, and the markets are becoming skeptical, but they haven't become disbelievers yet. I'd like to end by showing you a slide we used for nearly 2 years to end our Global Insights audio shows in 2009 and 2010. Ty and I always would say, don't worry, they'll print the money. It proved to be 100% accurate. But nothing has changed since then, other than the Fed no longer has as many options as it did years ago. So, I will repeat, don't worry, they'll print the money. You can bank on it, and you can invest on it. That is the telling point here. That's how you know what to look for and what event risk is really important or not so important. In closing, I'd like to take a moment as a reminder, do not trade from any of these slides. They are, and as is the discussion, for educational and discussion purposes only. As negative as these comments often are, there has seldom been a better time for investing. However, it requires careful analysis and not following what has traditionally been true and tried approaches. Do your reading and make sure you have a knowledgeable and well-informed professional financial advisor. So until we talk again, may 2014 turn out to be an outstanding investment year for you. Thank you for listening.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.